So good morning, everybody. For the people who don't know me, I'm Dino Paparelli. I run a real estate debt at Deutsche. I have the pleasure to moderate the panel today. But before going to that, let me just spend 2 seconds to congratulate with the organization of this conference. I mean, setting something up like this in the middle of a COVID in this year is remarkable. It testifies of the drive, the enthusiasm, and the dedication of the people behind this conference. And in a year like this is a source of inspiration. And also, it also send a very positive message. Okay, the things can happen no matter what. So well done, bravi to all. Let's get into the panel now. I will ask you if you guys can introduce yourself and just spend 2 seconds quickly on the role you have in your institution. I know, Jeff, you want to kick off?
Sure. Thank you, Dino. And thank you, NYU, for having us again this year. This is always a highlight for us. I brought a sport coat in today. I was thinking I would be wearing it because we always wear one to the conference. And I was thinking that'll be the first time since March I'll have a sport coat on. So thankfully, you guys aren't wearing one, so I don't have to either. I'm president of Starwood Property Trust. We are the largest commercial mortgage REIT in the world. We run a diversified business model. About 50% of our assets are in our large loan lending business that Boyd knows extremely well and is executing away from here. You'll hear more about. The other 50% is a combination of things. We own a company that used to be called LNR, which is one of the largest special servicers. We're a large CMBS B-piece buyer. We're a large CMBS originator for conduit loans. We have a non-QM business with about $3 billion of assets, which is not residential loans effectively. And we have an energy infrastructure business with a couple of $1 billion in loans. So we're fairly broadly diversified there. We also own about $3 billion worth of real estate, sort of core real estate. So diversified mortgage trust. And again, happy to be here.
Thanks. Boyd?
Hi, I'm Boyd Fellows. Thank you. Also, being part of this conference every year is also a highlight for me in a big way. I'm one of the 4 guys that founded Acore Capital, and we're using the same line that Jeff used. We're the largest pure commercial real estate credit platform in the world. We have about $16 billion under management. Our strategy is strictly focused on commercial real estate lending in the United States. And the vast majority of our activities are focused on floating rate, transitional real estate loans. A typical down the middle loan for us is roughly $100 million, and it's anything from ground up real estate to light rehab. And then we have a small fixed rate program relative to Jeff's, but we're a very, very active lender in the U.S.
It's great. Let's kick off the discussion. I guess today, 2 or 3 topics I would like to touch base on. Obviously, discuss about risk, discuss about liquidity. If we have the time to discuss a little bit more in detail some specific asset class, but let's start with you, Jeff. 2020, the pandemic, this year, how your appetite for risk has changed over the last 9 months. What is also the change in the approach to risk mindset, and if you want to know how much of this change, if any, is here to stay, or do you think it's just something contingent to the situation?
Yeah, thanks, Dino. It's certainly been an interesting year for all of us. Re-underwriting a $17 billion portfolio, probably 5 times over Zoom over the last 7 months or so has been really interesting. I would say we had a great advantage coming into this. Nobody knew it was coming, but given the diversification of our business model and having over $3 billion of unencumbered assets that could help create liquidity, we had tremendous liquidity coming in. We had over $800 million of liquidity coming in. We never dipped below $650 million or so of liquidity, and we had large pools of assets that we could create liquidity on if we needed to. We also had $3 billion of owned equity that we could sell if we needed to, and it's bond-like owned equity. So when COVID came about, obviously we were all figuring out with our relationships at our lender banks where our potential holes were on some of our properties. Hotels obviously going to zero occupancy overnight created a little bit of a hole in the P&L and something that we had to deal with, and we worked closely with our bank partners for the first few weeks to make sure that they were comfortable, and they acted like tremendous partners during this whole process. But unlike most of our peers, we were able to go on offense fairly early. We invested $1.5 billion last quarter, and most of that is stuff that we signed up in April or so. There were not a lot of loans to do in the bottom of COVID. There were not a lot of people looking to write a new loan. Obviously, transaction volume has been down significantly, so you couldn't increase in your loan book very quickly. But we, having this diversified model, were able to increase our assets in other places, specifically in non-QM residential, where whole loans trade on a daily basis. We were able to buy about $1 billion worth of loans in the sort of low 90s dollar prices that quickly recovered to being well above par today. And that's something that we did use some of that firepower on during COVID. Since COVID, we've invested in CMBS and B pieces, which got close to a 20% unlevered yield, and that's something where we think the collateral is probably better today than what we've seen over the last 4 or 5 years. Significantly less exposure to retail and hotels and other asset classes that were less in favor of more investment grade loans, better coverage ratios, et cetera. So we're happy to invest there. We're happy to invest in our broadly syndicated energy infrastructure business, and we're heading on a path to having enough loans in there to do a CLO early in 2021. So sort of excited about that. And we have made loans. We made loans in every quarter. So being an investor, being able to go on offense was sort of fun for us. We got to pick from the best places to be. And I would say that now we're at the point where we're more likely than not to start investing more aggressively on the loan side. Loan volumes are still reduced, and I'm sure Boyd is seeing it similarly. We're being very choosy. I think that we've changed, if anything, to try to do what we think makes the most sense for the business and what we think shareholders want us to do, and that's more multifamily, more industrial, more well-tenanted office, sort of less construction and future funding oriented assets. So we've reduced our future funding by about 35% since COVID started. We've reduced our construction book significantly, just to make sure that if there is a K-shaped recovery at any point, that we have tremendous access to liquidity going forward. So the risk to me going forward is that a lot of us rush towards the same asset types, that we all avoid retail, we all avoid hotels, we avoid construction to some extent, and we're all chasing the same assets, and we're chasing them tight. But we'll see how that plays out today. It hasn't gone quite there yet.
Gotcha. Boyd, how about you? Risk approach. What is actually something that in your risk approach that is this crisis is gonna basically change? Is anything you would basically keep with you going forward, even after the pandemic is over, about your experience going through the last 9 months?
Was that question for me, Dino?
Yeah, Boyd, for you. Yeah.
You're asking what changes we've made or changes we'll make going forward with respect to how we approach lending?
Yeah.
That's a good question. We have, just like Jeff, we have a really large book, and overall, it's done well. I guess what's going to change in our approach? Unlike the mortgage REITs, we have almost no leverage, and certainly almost none in the form of warehouse lines, close to zero. So that really was not isn't a component of our thinking. I guess. So I don't know that much is going to change in our core approach. We have an approach to thinking about risk that we call our 3 Bs: the basis in the asset, the quality of the borrower, and the business plan associated with the asset. And that's sort of our core, call it credit investment thesis that we stick to. And I don't know that any of that's going to change. I think we're looking back on it and as we come out of this and saying, hey, that really paid off really well. I think maybe one slight interesting twist to the whole thing is we have about 200 loans, roughly $15 billion. And when you triage it all and you say, okay, it's not that hard to say, okay, what's the most troubled loan in the book? What's the next most troubled loan? So you can quickly assess within that portfolio where are the problems, and almost all of the problems are associated with borrowers who have found themselves with serious liquidity problems. None of the problems are associated with the basis of the loan or the business plan of the loan. And the interesting aspect is that within that, and of course those borrowers who are having liquidity problems, we knew that going in, and so typically structured the deal either at a lower LTV or otherwise, went into it wide awake. It wasn't a big surprise. But it is interesting. So I guess the point, and when you ask me what we would change going forward, it may not be a change, but I think it will cause us to be all that much more focused on the liquidity associated with the borrower, because when things go all wrong, those are the subset, the small subset of the ones who are having the most trouble. And an interesting other twist is when you do the triage and you go down and you say, what are the most troubled 10 loans? Let's say all 10 of those loans have a borrower with, and we're not expecting losses in any of those loans, by the way, but the interesting thing is that those loans, a weak borrower, someone with liquidity problems, there's no correlation between that and bad assets. And so a lot of these assets that are associated with an illiquid borrower are excellent assets. And so, from an opportunistic lending or rescue lending perspective, the situation that's unfolding right now, there are some fantastic opportunities. In my mind, it's this where you have this overlap of a borrower who's found themselves to be very, very illiquid, who happens to own a great asset, and those are the kind of opportunities we're really targeting. Gotcha.
Thanks for sharing this. Liquidity is definitely how to address liquidity, both of the sponsor, also liquidity in the structure of the borrower is something that probably is going to be, something that will keep with us going forward. Let's move straight to some general topic is, when people look at this crisis, 2020, and start to compare to the previous one, Jeff, what do you think if, do you see any analogy to the previous crisis? And if yes, what are the analogy that you can see between what we experienced today, what we went through, 10 plus years ago?
Yeah, I think it was tremendously different. I sat in a role similar to yours. I was on the investment banking side then, and the speed with which this happened is just completely different than what happened in 2008 and 9. The speed of the reaction by the government, I think, really importantly, in the middle of March, how it was clear that the government was going to be there to help solve some of these problems. And we didn't see that. We didn't have that certainty in 2009. I'm old, and Boyd and I have been around this for a long time. I remember in Wall Street, the movie, when Hal Holbrook looked at Charlie Sheen when he was about to get arrested, and he said, Bud Fox was his name, a man finds his character when he looks into the abyss. And to me, that's what 2008 felt like. It was an abyss. I didn't know where it ended. None of us knew where it ended. We saw major banks go out of business, and you didn't know where it stopped. On this, it felt very finite from day one. We got to get our hands around liquidity. We knew it was 12 months to 18 months, maybe on the outside, 24 months, and there would be a tremendous amount of support from the government. And on the backside of that, we would heal and figure things out. So this was more about sort of cash flow than it was about credit to me. I think that the thing that happened the most quickly in Boyd's business model of not having any warehouse lines works tremendously well in times like this. You don't have to deal with any lenders in terms of voluntary pay downs on your warehouse lines, which a lot of us call margin calls, but some people call them voluntary pay downs. So we all had them if you had warehouse lines. Fortunately for us, we set up the business over 3 or 4 years before this to have the least amount of warehouse exposure of anybody in our space. Less than half of our CRE book is financed on warehouse. It's more expensive to do what Boyd does, which is to sell A notes. It's generally more expensive to do a CLO, although ours was accretive when we did it. We've created a tremendous amount of unencumbered assets to have unsecured debt. We have convertible debt, et cetera. So we weren't as levered to that, but it was clear early on that the sort of leverage cuts both ways. It's very positive in a good time, and it can be negative in a bad time. And I think that's something, as we look back now, people are going to be resetting their business models to have less of that potential voluntary pay down risk on their books.
It's actually it's a very interesting point that you raised, Jeff. And if you think about what was last year, this discussion, there was a fair amount of time spent about the distinction between the warehouse lending, A/B note, and then we get into the 2020 with the the dislocation, and then you see really the difference between the two. So, you
Yeah,
can.
Dino, I add, it's really interesting. I heard Barry say this recently, so I'm going to use his numbers. And one of the things you knew this whole year was the consumer, absent people who were unemployed, and that was terrible. And there are certainly sectors that still need to come back. But the consumer was sort of fine. And you knew you were going to be okay on the backside of this and that we will be okay because the consumer's sort of fine. Barry's number was $15 trillion of net worth was lost in the GFC.
Yeah.
This COVID crisis, $5 trillion has gained. So $20 trillion difference, and the consumer is $5 trillion better off than they were versus down 15. So it became a timing issue more than do we think that there's going to be strong lingering effects here? Certainly by product, there will be some, but I think that's an interesting data point.
Boyd, so you, the two crises completely different, or do you see any analogy?
You're talking to me, Dino?
Yeah.
Between the GFC and now?
Yeah.
I think Jeff, hit it right on the head when he brought up the speed as being the number one thing, the speed that it unfolded and the speed. I agree with everything Jeff said. That was a very, very different situation to this time across the board. So, I don't know how much to add to what Jeff said. He covered it really well. I think that maybe the biggest difference that I think unfolded between the two is that the global financial crisis was really unfolded, largely driven by derivatives and bank issues, but it very quickly turned into it affected almost all investment industries in a very balanced way for the most part. This crisis strikes commercial real estate, far more severely than almost any of the other investment classes other than the airlines. And it's this compounding effect. So the global financial crisis created this huge recession, right, where business activity declined across the board. But the fact that in this case we have a pandemic that's based on a contagious virus makes physically occupying commercial real estate buildings a major problem. And that's not the case for a whole host, like financial sector. The contagious nature of the virus isn't particularly devastating to the financial sector. Like, it makes every single building hard to occupy in the same way that we did in the past. And so, we look at and then you compound that with the recession associated with the pandemic. So we think that real estate has been more dislocated, as I said, than virtually any other industry other than the airline industry. And so we're all of us in the commercial real estate industry are I think much more severely impacted than, use the hotels as the perfect example. And you look at what happened in GFC, sure, demand for hotel rooms dropped, but it didn't go to zero across the board. You didn't have occupancy of offices, go to actual occupancy of roughly 10% in most major metropolitan areas. These are all factors that are very unique. And one of the things that I think is exciting, not exciting, that's the wrong word, but it creates a great opportunity for those of us in commercial real estate over the next 12 to 24 months as our industry, goes through this process. And, it's going to take some time for this to all work out. We do not think that, even though, as Jeff said, the government acted immediately, stock market and a whole host of other factors have improved quite quickly, and there's a vaccine around the corner. That isn't going to bring ADR and occupancy levels back to normal for a few years. This is going to take a long time, even though we'll have a lot of other industries come back quite quickly. And all of those things create opportunities for all of us to, as Jeff said, go on the offense, to provide rescue capital, to be the solution for our clients to really and make money, for our investors. So I think we're in a really unique spot this time, and we weren't in a unique spot the last time.
Yeah, definitely. Of the monetary stimulus, the fiscal stimulus this time has been way faster, way bigger than before, and then these are about addressing the issues. Hey, Boyd, let's stick to you. Some of the people are predicting a wave of distressed debt coming out of this crisis. Do you agree with that? What's your view? Are you expecting more lenders to take a wait and see approach? What's your what's your view about a possible distressed market coming to us?
Well, I think that, so far most lenders have had the liquidity to and the wherewithal to hold the loans on their books. Also, when this thing first happened in March, all of the lending community really tried to be part of the solution, and we're very quick to provide forbearance, to provide relief, to help, to provide to be quite generous in terms of how we were responding to our borrowers. And across the board, that's ended. Virtually all of the lenders are saying, okay, it is now time to start paying your rent. And so, when we're not providing forbearances at all, and if we are, it's in return for something very material. So my point being that you're going to start to see defaults that unfold now, starting in the fourth quarter and accelerating in the first quarter, particularly in the hotel sector and potentially in a few other sectors. And once that begins to happen, there are a number of lenders, but mostly regulated lenders, so not like Jeff or call it Starwood and Acore and other private lenders. But in the bank world, once loans go into default and the default proceeds, their regulatory capital changes, and then those loans don't make sense to hold. And what they will cease, solving. They won't avoid the loans being delinquent by providing forbearance. And once the regulatory capital starts to rise, we expect an acceleration of sales out of the banks. So we're hoping, because we're, as Jeff said, on the offense, we would imagine that to start unfolding in the first and second quarter, and driven largely by regulatory capital charges that will push them off the bank's balance sheets.
Gotcha. Hey, Jeff, I want to go back to a point you mentioned before, mark-to-market, mark-to-credit provisions. What's the lessons we got from this crisis? And are you expecting any major, apart from what is the setup on your organization, but are you expecting any change in the, market-wise on how these provisions will be used going forward?
Sure. First, I just want to touch on a couple of points. Boyd made tremendous points, and I think where the distress on the loan side will come out of is more likely from the banks. When you look at a Starwood or a Blackstone or a number of our peers, Acore, people who are real estate professionals in these seats. So when we see distress in loans, it's unlikely that we're going to be sellers of these loans. We're actually hired by our shareholders because we're able to work them out. We've taken the keys back on 2 assets out of 44 billion that we've lent on, and we actually made a significant profit, an 8-digit profit on taking those back and bringing tenants in to re-tenant them. I think one of the reasons why the people who run a lot of these bigger REIT companies are doing so well, and why the shareholders trust in them, is because they have large equity departments who can work through that. But I'd also say our average loan is 61% LTV. Even on our hotel book, we've had almost every one of our sponsors put in significant amounts of equity. I just don't think at those LTVs that we're going to see a significant amount of distress come out of books like Boyd's and ours and some of our larger peers. So given what our biggest tenant is probably having strong borrowers when we go into this, and you reward yourself in times like this for having those strong borrowers, and it tends to pay off. I think you then asked me about mark to market and how it will change things going forward. I think that you look at where the margin calls or the voluntary paydowns came the first time around, and clearly it was on securitized products first. Things like SASB securities. There are active trading prices in the market. It's very hard to hide from those. We saw AAA bonds on capital stacks that we thought were absolutely brain dead money good trade down into the low 70s dollar price in the second week in March. And there's nowhere to hide if you own SASB securities and you've taken extra leverage on them. That's the first place that you're going to have a problem. The second place is hotels, which went to zero occupancy. So I think we'll learn from those two things. We'll probably have smaller hotel books. Hotels are only 12% of our assets. Hotel loan books on 12% of our assets, but I think as an industry we'll learn from that. We'll learn from the how quickly the mark to market can happen and how quickly it can change. And we're going to focus more on better sponsors going forward, even more so than we did going backwards. So I think the other thing that a lot of people worried about, and we had great liquidity, so we didn't have to worry about it as much, well, is the difficult part of construction lending is that it does require you to do a significant amount of future funding down the line, which we always look at as a sort of pre-investment and a nice use of our capital. We've always kept it to mid-teens % of our book because we want the other parts of our ecosystem to always be able to contribute enough equity to pay those future fundings down the line if something like this happens. You couldn't run a construction-only fund, but I think as a result of this, we're all going to take down our future funding. We'll take down our construction. We'll certainly take down our securities repo and our leverage. And we're fortunate as probably the least levered in our space to have a good place to start from, but we'll continue that process because mark-to-market happens quickly.
Gotcha.
Hey, Dino, it's Miriam. First of all, I'm on the phone. I apologize. You would think after 8 months of a pandemic, we could all figure out technology, but unfortunately couldn't get the camera to work, so I am dialed in. I wanted to comment on your question around distressed selling from a bank perspective, if that's okay. I actually don't think you're going to see a lot of selling out of the banks. I think some of the vaccine news takes a little bit of the left tail risk off the table. And I think we've even seen borrowers being a little more willing to write another check to live another day and buy another 6 months. So I think the banks are pretty healthy this time around, and I don't think you're going to see large selling.
Gotcha. Thank you. Thanks you for joining with the with the phone. I know there's been some slowdown in the application. Hey, Miriam, let's stick to you 2 seconds. I would like to ask you, something like pick your brain on, after the outbreak of the pandemic, obviously CMBS market came back more quickly and is fully operational. When do you see in particular on the banking side, the own loan market coming back, and in particular for transitional loans?
Yeah, it's a great question. You mentioned the CMBS market coming back, and I think it did come back in terms of there was a conduit deal in May and then some SASB issuance over the summer. I think we have heard a lot of complaints from investors that in that March, April, May timeline, CMBS really underperformed IG and high yield from a liquidity perspective. So I actually think that that will hurt the product long time, and that investors are kind of disappointed with what they perceived as the lack of liquidity in the product. On the question on balance sheet lending, we actually stayed quite active over the last 9 months. So we've put out more than $7 billion of capital across our warehouse, CMBS, and balance sheet lending. We're probably doing twice as much balance sheet lending this year as we were last year because we saw this opportunity set where many of the money center banks and some of the debt funds were very much on the sidelines. And so we were able to make loans on properties at higher spreads and a lower basis than what we would have been able to do 6 months before, really because there was no competition. I think to your question, we are seeing more competition come back to the market each week. So it does feel like a number of the money center banks who were on the sidelines are again starting to lend, and we're hearing that they expect to be more active in 2021. That said, I think we're a long way from seeing a robust market for transitional lending. I think a lot of what we have been doing and many of our bank competitors is much more down the middle from a risk perspective, where we really want to have cash flow day one and less active in the sectors that have been highly impacted by COVID. Gotcha. Thank you.
Dino, I wanted to throw out one thing. It's an interesting, this is always a great panel because the group that's on here are the best of the best, and Jeff and Miriam are exactly that. But one thing that we're doing a little differently than Jeff is construction lending. And it's partly our model because we're unlevered and the capital we have is unlevered, but we're actually been increasing our activity in the construction and very heavy rehab area, and it's partly driven by the fact that Jeff and others are not. And so I don't want to call it like shooting fish in a barrel, but we're getting construction loans done as you said, Jeff, in multis and industrial that's infill that we like. All industrial are not the same. That sector's got some weak links in it too. But anyway, we're getting them done at LTVs that are basically, if we used to make apartment construction loans at 75 LTV, we're getting them done at 60 and 55 LTV, dramatically, or LTC, I should say, on the construction loans, and getting them also done at 100 or more basis points wide to where we used to get them done at the higher LTV with better structure. And one of the twists to that we really like is that these things are not going to come online until past when we would anticipate, a normalization in the economy. But that's all compounded by the fact that the regional banks that are out, the large commercial banks are largely not coming into these deals. And we wind up in competition with, these two-handed package deals where it's a small regional and a mezz shop, and the borrowers would always rather go to the likes of the three of us, a one-stop shop. So that's a little difference in terms of our approach. Certainly we're not lending on hotel construction or anything, but in the spaces I'm referring to, it's pretty good.
Yeah, boy, listen, I think you're swinging in the right lane, because the risk reward was always superior, I think, to things with cash flow. You got a significantly lower LTV, LTC. You got paid a coupon that for us helped us create a lot of unencumbered assets that helped us create unsecured debt and made us a serial bond issuer in the unsecured side. So we will be back in that lane. I think we're choosy right now in that lane. We certainly haven't closed that door. We're going to be choosy, but I think a big part of it is figuring out how do you do it without taking a senior or a warehouse and doing it completely unlevered. It would be interesting for us, or doing with an A-note sale. We're just less likely, and I think our industry, meaning the public REITs, really started using warehouse on it. We did significantly less of that, and that's probably something you won't see come back in late 2020 or early 2021. So I agree that you're swimming in a very attractive lane.
I would encourage you to take your time. So guys to come back.
Hey, boy, let's speak more about construction, because obviously construction has been a sector that's been affected by the pandemic, lockdowns, stay at home, all that. How do you see this sector? You say you're active. How do you see the lending for construction changing going forward? How do you, what are the part of the usual construction structure that you think they can be more affected by this pandemic? You talk about lower leverage, higher spread, fine, but what about setting up milestones? Do you think actually there's going to be any change in the way lenders will look at construction structures, or what's your take on this?
That's an interesting question. I don't have off the top of my head idea as to how we'll change structure as a result of the pandemic. We were already, pre-pandemic, very active, one of the most active private lenders in construction space. And as Jeff said, we've viewed it as, having exceptional risk-adjusted return. As long, we're able to be all of us are able to be very picky, very, very, very selective, and get, trying to get the best deals, in particular with really, really, obviously in construction, the quality of the borrower is critical, and their sophistication and their experience. So I don't have a top of mind how things will change, how we're changing things, in the near term. I mean, it's more of being a little more, I guess, tactical in terms of which property types and in which markets and on which street. Very, very, very careful about avoiding supply. In multifamilies, that's, supply is the biggest problem that you can run into. So I'd say we're being, but we always have been very tactical in terms of the markets and targets. I mean, borrowers, sponsors, and property types. So it's hard to say we're going to become more careful than we already were. I think it's just an environment where we're being opportunistic, and we're able to get recourse on deals that we would never get recourse on before. And even if it's 10% recourse, it can really make a difference with these kinds of high quality borrowers in terms of your results.
Dino, it's Miriam. I think on that point, I think we're also seeing lenders be even more focused on the amount of cushion that you have. So let's say that you have a pre-leased building, and normally you would have 12 months of cushion in terms of when you expect the building to be delivered, and then when the tenant starts having remedies if you're late. I think lenders are saying maybe that needs to be 18 months. What kind of force majeure provisions do I have, just to make sure that if there is any sort of further delay or shutdowns of whole cities like we saw, for example, in Boston in March and April, that you're really protected. And I think to Boyd's point, sponsorship really matters here. What we saw in our construction portfolio was that our top tier sponsors were able to get back to work really quickly. They found creative ways to get people back on the job. They're really, for the most part, not behind despite losing, weeks or maybe even months in some situations. And so I think it goes back to the point that you really have to be lending on the best projects with the best sponsors.
And Dino, I'd add quickly that, Boyd mentioned earlier that being in construction gives you a buffer time-wise until we get through COVID, and I totally agree with that. Yeah. But at the same time, you're delivering into a less certain market, because I don't think any of us know where the markets are in 3 years. Certainly, office is probably the biggest question mark of how do we come out of the pandemic on the backside. And so speculative office is probably something that's very difficult. Well-tenanted, pre-leased office, absolutely very easy. We're all going to lean in there. We've done single assets for AmerisourceBergen, British Telecom, Facebook. You get clients like that, and we're going to lean in to do that. But I don't think going into a speculative market for whether it's hotels or certainly retail, which I don't think any of us are going to be writing that loan, or even office today, not knowing what the office environment is going to be in 3 years, just makes it a little bit more difficult. So pre-leasing along with sponsorship is more important than it's ever been.
Yeah, you introduce a new topic, which is, office in commercial real estate, such an important asset class. I know, Miriam, I come back to you now. Lockdowns, people doing, working from home, smart working, as the term they use in Europe, is the concept is the same. How do you think this is going to affect, liquidity for, the office sector going forward? It's going to be, please.
It's a great question, and I think a lot of what investors are debating right now is when you look at the publicly traded office REITs, they're all still collecting 95+% of their rent. So from a current income perspective, it looks great. At the same time, sublease space in New York is at the same level that it was at the great financial crisis, almost 15%, and leasing momentum is down 77% this year versus the 5-year average in New York City. So those are big numbers that I think, for good reason, give people a lot of pause, because there just aren't a lot of data points in terms of new leases and then how much space is actually going to be available. I think what we're seeing is that there's still strong investor demand for office assets that have a lot of lease terms. So we did a transaction over the summer where you had 11+ years to Netflix, and it was incredibly well received by investors because you had great credit and term, and I think investors still want to invest there. You're really seeing, though, the market push back on buildings that have a lot of near-term roll, just given the massive uncertainty. I think my personal view is that it's much more efficient to be in the office, and I don't think everyone's working from home forever, but there's clearly going to be downward pressure on rent and occupancy, and that's going to take time to play out, particularly in the New York and San Francisco type of markets.
Yeah, those commuter cities are really going to bear the brunt of it in our mind. In New York and San Fran are going to take an awful long time. Fortunately, we have less than 0.5% of our assets in San Francisco, and I think less than 4% of our assets in New York City loans. So we sort of avoided them, but that's going to be, I think we all want to get back to work, and being back to work. And I've been back to work after the first 7 weeks of sitting on Barry's kitchen and sitting next to him for it. I think we've been back 95% of the days, and most of the people at Starwood are. So it feels good. I feel much more comfortable being back at work. And as the junior people continue to arrive, I think they feel the same way, but it's going to take a lot of time, and there's a lot that we don't know. And I think going back to the last discussion we just had on office, which is construction, if there's less speculative construction, I think it's going to be one of the things that bails us out of this hole in 2 or 3 or 4 years, with less new supply hitting the market. If there is a bigger Zoom economy and less desire for space, I think it will ultimately help us that we're going to have less speculative construction as we look forward 3 to 5 years.
Yeah, Jeff, sticking to you for 2 seconds, talking about, asset class winning and losers, obviously hospitality is an asset class which has been affected the most probably during the last 9 months. We got, the announcement by Pfizer this week, the perspective of a vaccine, do you think is going to be enough to reopen the market for lending in the hospitality sector? Or if not, what do you think is going to be, the timeline for reopening to reaccessing liquidity in the hospitality sector?
Yeah, I think there's going to be winners and losers, Dino, and fortunately for us, our book has been predominantly in extended stay, which has performed tremendously well and is back to 80% occupancy. Limited service stuff, we're seeing the numbers tick back up. Destination hotels, we're seeing them pick back up. Right around the corner here, we have the one hotel, and we're seeing great weekend occupancy now, and it's starting to pick back up. Fortunately for us, what we don't have in our book is the ubiquitous Ritz-Carlton in Chicago, Atlanta, Boston, New York, San Francisco, business travel box, $500 a night, convention center boxes. I think those are the things that are really going to take the longest to come back. So I think the hotel world is going to be relatively bifurcated. The destinations are going to do fine, and the limited service and extended stay will probably pick up more quickly. I think most of us are going to underwrite those city travel boxes very cautiously, given all that we don't know about airlift and the desire for people to go to as many conferences in the future. But at the right price, and Boyd made the basis argument earlier that there are certainly good loans to make, and I think that it won't be a zero forever. But right now, given all that we don't know, it's hard to lean in. I would say that looking 3 to 5 years out, I think the office market valuations are going to be lower by more than the hotel market valuations are going to be if I look 2 or 3 or whatever years out. So if you have a longer term view, I think that you can certainly make a statement on hotels returning cash flow probably more quickly than some other sectors.
I think the one challenge we're seeing, though, in making hospitality loans is that if you manage your portfolio to, say, a third hotels, all of the hotel loans that you had pre-crisis, you still have today, because none of the hotels have refinanced according to their business plans for obvious reasons. They're all shut down or have very low occupancy. So I do think that is one challenge with adding hospitality product, is just that it may make your overall concentrations different than the way you want them to look, just as a function of what's going on with your pre-COVID loans.
Gotcha. Boyd, anything to add on, lending in hospitality? What's your view? Is the market reopening at a certain point? Is it going to be the vaccine? What do you think?
I agree with I like Jeff's point a lot that, 3 or 4 years from now, I'm more worried about office than I am hotels. We do think a lot of the big box hotels will, we've got a list of hotels we already have in our minds in New York and other markets that we don't think will ever reopen as a hotel. Those things will wind up as residential properties of some sort. So that sector, other than the big box hotels that are convention and business, the rest of it, I think, is long-term in better shape than office. And I'm right there with you on that. In terms of the hotel lending space, in my mind, there's going to be hotel lending. It's going to be rescue capital. It's going to be a separate sort of, for the people who will be lending, the investors who will be participating in lending in hotels is going to be a very opportunistic group. And, so to Miriam's point, like, none of our current investors want to see the hotel percentage in their book go up 1 penny. But that said, you can, accumulate capital that has a different orientation that is opportunistic. And I really do believe that the biggest opportunities that are going to unfold in commercial real estate as a result of this pandemic are going to be this overlap between those great assets in the hotel space where the borrower is in deep trouble due to liquidity, and that's occurred in cases because when we underwrite loans, all of us on the phone, you look and you come up with a net worth and a liquidity target or covenant that you associate with someone who's borrowing $100 or $200 or $300 million. And you look across the portfolio, but in the hotel space, nobody really thought about some of these otherwise well-capitalized, very sophisticated borrowers, the liquidity that you thought and they thought was necessary. You never envisioned a scenario where every one of their hotels in every single market would go to zero overnight. And so that's another example. So it's those hotel borrowers who are entirely concentrated in hotels and that own great assets. Those guys that's the opportunity that we're really focused on and focusing on that, but with slightly different capital than our regular way business.
Gotcha. Talking about, sorry, Miriam, coming back to you on another asset class that captured a lot of attention on the headlines, which is the condo market. New York in particular. There is a significant stock of condos that need to be somehow managed and refinanced. What's your view of how the market, the lending market, will look at these at the stock of apartments? Do you think people will just adjust their basis, or you see lenders trying to get capture part of the upside and take more risk? What's your view on this?
Sure. So first of all, I think we have to remember not all projects are created equal. And so this is going to be very much an asset by asset specific underwriting. I think we've seen a lot of condo inventory loan requests on really tough projects where we would not have been interested prior to COVID, and you're even less interested today. I do think if you're talking about the best product and a sponsor that still has some liquidity or new capital coming into the deal, there are potentially transactions to be had. With our bank capital, we would want to be at a very low basis, just a super senior A note, not taking a lot of risk, and we'd be less focused on some of the participation features that you just mentioned, i.e. more upside. I think we would be looking to feel like we could sleep at night, and even if it takes a while for New York to come back, that our basis would work as a rental and ultimately could get us out from a sales perspective. I think we may look to partner opportunistically with more opportunistic capital, where perhaps there's a junior partner in the capital structure who is looking for more of that upside participation, but that would not be our plan of attack.
I understand. Thank you. I don't know if we have more time available from the screen. I don't understand if we are, probably 4 more minutes. Because for everybody is, 2020 has been a, hell of a year. What's your expectation for 2021? I know, Boyd, do you want to kick off?
I'm really looking forward to 2021. I feel like we're really well positioned to take advantage of the opportunity that's going to unfold. Fortunately, our $15 billion portfolio is we're very cautiously but legitimately optimistic that there's going to be no exceptions. It's going to go well. So, I think commercial real estate, as I said earlier, is far more dislocated than almost any other industry, and all of us on the phone are really active players. So I think things are going to start both. I think the economy is going to start to turn. Things are going to start to get better, but real estate's going to lag, and that's going to be an opportunity for us. So I think our business is going to be very, very interesting next year.
Mm-hmm. Jeff?
Yeah, listen, I think, fortunately and unfortunately, payoffs will be slower. There are certainly some borrowers who have high LIBOR floors who will want to take advantage of getting out of those given where LIBOR is. But we've seen a $500 billion plus market for loans the last 4 straight years. We saw that in 2007. In between, the market was smaller. It's going to be smaller in 2021. Most of us are going to have less rolling off, as Miriam said, so we'll be forced into doing less. I think there are great opportunities today, not only here, but across our 7 cylinders. We're probably going to continue to invest almost equally across them to see where their relative value is. But I think it'll be another year spent making sure that we have the right side of our balance sheet as diversified as the left side of our balance sheet to be prepared for whatever that next storm is, because we don't know when it's coming and we don't know what it is. For all the young kids out there, you guys are learning Excel and how to model real estate. And Barry always says, if you run revenues up 3% a year and expenses up 2% a year, everything looks good. But the only thing we know is that those models don't ever come out to be exactly that. And so some of the modeling mistakes that we'll make going forward, I think as I project to 2021, every office deal that I see today seems to be a pivot to life sciences. Really easy, go from $50 rents to $80 rents. It's just simple in a spreadsheet. It looks brilliant, right? But we're going to have things like that just get sort of overplayed, overheated, and we have to make sure that we're putting some sanity to spreadsheets to make sure that we're keeping ourselves in check on optimistic assumptions going forward. So we'll run stuff to the downside, and I think there's a tremendous amount to do as lenders. And again, at 61% LTV, we're going to be able to put 2020 behind us pretty soon and not really worry about any substantial hits and start moving on and going back on offense, which will be super exciting for us.
Gotcha. Miriam, 2021?
We are really excited about 2021. I think if you look at the broader capital markets, the market believes that a Biden presidency and a Republican Senate is really a Goldilocks scenario for risk assets. So I think the market backdrop is going to be really constructive. I think the vaccine news takes some of the left tail risk off the table. And so you're going to see people having confidence to do deals. And we think there's going to be a lot to do. So we're incredibly excited about 2021.
Thank you.